Today, we're going to dive into a topic that, let's be honest, is on pretty much every investor's mind these days: geopolitical risk. You know, you turn on the news, you see conflicts happening thousands of miles away, you hear about new trade tensions, and it is so easy to feel like your portfolio is just, you know, at the mercy of whatever the latest headline is. And if all that is making you a little anxious, yeah, I get it. But here's the thing. There's a much better way to handle this than just worrying. So in the next few minutes, we are going to cut through all that noise. We're going to look at what geopolitical risk actually is, and more importantly, what history and the data tell us about why hitting the panic button is almost never the right move for your money. So let's get right into it. And let's be real, the world today is, well, it's complicated. We've got active military conflicts, really tense trade talks between global superpowers, and supply chains that are still kind of reeling from major disruptions. It's this exact mix of events that can cook up a perfect storm of investor uncertainty. So, let's start at square one. What exactly is geopolitical risk? I mean, it's a term that gets thrown around all the time, but what it actually means is pretty specific, and it's really, really important for investors to grasp. Okay, so at its core, geopolitical risk is really about the potential economic domino effect from political stuff that crosses borders. We're talking about things like wars, sure, but also international sanctions, major trade disputes, or acts of terrorism. Basically, it's any big event that messes with how countries deal with each other, which in turn messes with how the whole global economy works. And this slide makes a really crucial distinction here. Geopolitical risk, it's not the same as political risk. That's usually something domestic, like a new tax law in one country. And it's not economic risk either, like when a central bank decides to raise interest rates. The key word for what we're talking about, geopolitical risk, is transborder. It's all about the friction and the events that happen between nations. All right, so we get what it is, but how does a conflict happening thousands of miles from you actually end up affecting the money in your retirement account? Let's trace that path. Well, the impact basically travels down two main roads. First, you've got the tangible, physical, economic disruption, stuff you can actually measure, like a blocked shipping canal or a sudden spike in gas prices. But the second road is just as powerful, and that's the intangible stuff, market sentiment. It's that collective wave of fear and uncertainty that can trigger a massive sell-off, all because investors are reacting with their gut. This slide here, it lays out that chain reaction perfectly. You could almost see the dominoes falling. It kicks off with a conflict, which instantly creates a cloud of uncertainty. That uncertainty then hits critical supply chains for goods and, super importantly, energy. Then, when energy prices shoot up, it hits everyone's wallet. It's like a tax on the entire global economy, and that pushes up inflation. Now, not all your investments react in the same way. As you can see here, during a conflict, investors often sell stocks out of fear, right? That causes markets to dip. So where does that money go? A lot of times, it rushes into what people see as the safety of government bonds. At the exact same time, things like oil can spike because of supply fears, and gold, well, gold often rises as investors flock to that classic safe haven asset. It's a place to park your money when things get turbulent. Okay, I know that all sounds pretty scary, but this is the moment where we all need to just take a deep breath and look at the data, because history gives us an incredibly important and honestly a very reassuring perspective. Believe it or not, markets have lived through every single one of these massive shocks. And as this timeline shows, yeah, the initial reactions, the drawdowns, they're always sharp. A drawdown, by the way, is just the fancy term for a fall from a peak to a bottom. I mean, look at Pearl Harbor. The market fell almost 20%. After 9/11, over 11%. These are serious, serious drops fueled by pure uncertainty. But like I said, that's only half the story. Here's the other half, 39. This number right here is maybe the single most important takeaway from this whole section. It is the average number of days it took for the US stock market to get all the way back to where it was before these major shocks. See, the initial drop is driven by fear. The recovery, which has historically been pretty darn quick, is driven by long-term economic resilience. And that leads us right to this key insight. In the heat of the moment, every crisis feels like the big one, the one that's finally going to break the system. But what history shows us over and over and over again is that markets eventually look past the short-term shock and they refocus on what actually drives value, the fundamentals of the economy. So, armed with this really crucial historical context, what are we supposed to do about it? let's put together a practical playbook for how to manage your portfolio in this uncertain world. The goal isn't to become some kind of geopolitical expert who can predict the next crisis. Trust me, that's a fool's errand. The real goal is to build a portfolio that is tough enough to handle the crises you'll never, ever see coming. So how do we do that? Well, it really boils down to 4 main strategies. First, diversify. This is the absolute foundation. It just means spreading your money across different sectors, industries, even different countries. Second, understand your exposure. You should know which of your investments might be extra sensitive to a conflict in a certain part of the world. Third, think about holding some safe havens, like gold or high-quality bonds, that tend to hold up when stocks get rocky. And finally, the most important one of all, stay the course. And I really want to stick on that last point because it is the most powerful tool you have. Your best move during a crisis is often no move at all. Emotional, headline-driven trading is just a recipe for selling low and buying high. Just remember this. The market's short-term knee-jerk reaction is driven by fear. Its long-term direction is driven by fundamentals like innovation, earnings, and actual growth. So, let's end by just reframing the whole question. The ultimate takeaway here is about shifting your perspective. Instead of constantly asking, what's the next headline going to do to my portfolio, maybe the better question is my portfolio built to withstand any headline? The goal is to move from being reactive to being prepared, because as history shows us, without fail, the storms of today always eventually give way to the clear skies of tomorrow.